Hey guys, another decent week here in the markets. We actually did have a very small hiccup on Tuesday with some Trump tweets that the trade deal might actually happen after the 2020 election. And then the stock market actually fell considerably. And then the charts went right back up the very next day when he said that trade talks were going well. So I love when Twitter fingers cause billions, maybe even trillions of dollars of money being moved around. But I certainly don't mind because that's a chance for me to be buying stocks on a dip and keep observing those buying opportunities. Today, we will be talking about 3 discounted dividend stocks. Now, just because they have had a little pullback here, that doesn't automatically mean that they are at a great valuation, but they might be worth keeping an eye on. We're also getting super close to that 1,000 subscribers mark, so if you guys could please help me out and subscribe to the channel and smash that like button for the YouTube algorithm, it really helps small-time YouTubers like me get my name out there. So without further ado, the first stock and the only stock that I actually own is Starbucks. Now, Starbucks is the first stock we're going to talk about, and I'm going to be keeping an eye on this for the 2020 and the whole decade. Because what's got me excited for this stock is in the next decade, its expansion is going to be in one of the world's fastest growing economies, which is China. Now, it's set its target on penetrating the Chinese coffee market for further expansion. Keep in mind, this is a market that has been dominated by tea for centuries. But Starbucks, of course, is a master at programming people to be interested in coffee, even if they didn't even realize that they were interested in coffee. Their new CEO, Kevin Johnson, who took over in 2017, said he knew exactly what it took to be successful in China, and that's having to switch to their more digital payments crowd. And this is something I really don't understand why we aren't doing more of here in the US. When I'm at the grocery store, I cringe every time when someone is counting pennies or slowly reaching for bills rather than just swiping a card, whether that's a debit card or a credit card. Plus, I think it's much safer when people are just carrying around cards than carrying around large amounts of cash, but that's just me. And Starbucks plans to have around 6,000 stores in China by 2022. It's currently at about 4,000. Now, Starbucks always seems to make the news every few months for what customers in their store do, or maybe sometimes it's what they don't do. But their new Starbucks Now stores are made specifically for on-the-go people, meaning that many of the restaurants have limited seating. It's more catered toward mobile ordering online and picking up via on your phone or digitally, thus making the service much quicker. That doesn't mean that competition is non-existent though, as this is one of the easier barriers to entry industries. Luckin Coffee has nearly 4,000 stores in China as well. They have had incredible revenue growth of $216 million in Q3 compared to just $35 million in the same quarter just a year ago. But what Starbucks has is it has a 2-decade head start in China. And of course, that Starbucks brand and logo is very valuable. It almost has like a cult-like following for their innovative and tasty drinks that customers continuously keep coming back for every morning, sometimes even twice a day, maybe even 3 times a day. The Starbucks reward program gathers huge amounts of data on customer spending and preferences. Then that information is personalized for each customer based on their spending habits, mined by artificial intelligence, which means it may even suggest new food or drink options for customers, sometimes depending on the time of day. You might think that there is a Starbucks at every corner, but each location is actually strategically placed and well thought of using information from analytics and data gathering. This helps avoid cannibalization of stores competing for the same customers. Now, Starbucks is trading slightly below its 200-day moving average, but at a forward PE ratio of 25, it may still be a little bit more on the expensive side. Now, a stock that is on a little bit of a pullback is Public Storage. Now, I made an entire video on this stock just a few weeks ago, so make sure you watch that animated video for a bit more detailed and in-depth analysis of the company. Some of the highlights I talk about in that video include how there's very low capital expenditure to build and maintain public storage units. There's lower turnover compared to residential real estate, which we're probably more familiar with. And the break-even point of public storages is at around 30% occupancy, but they actually currently have over a 90% occupancy rate, which is 3 times more than the break-even point. And they're also the industry leaders in self-storage in the US, as most of their competitors are just simple mom and pop shops that don't have the resources and aren't really planning on expanding like Public Storage is. Its price of $213 is currently well below its 200-day moving average of $240, and certainly is below its 52-week high of $266, giving you nearly a 4% starting dividend yield. And let's face it, you're going to be getting a lot of useless junk this Christmas, so I really want you guys to start practicing that face that you're going to make when you pretend to like a gift that you actually hate. While it may be rude to throw out a gift, it's somehow tolerated to just throw it in your storage center, never to be seen again. It's Public Storage's problem now. And then finally, how can we not talk about Home Depot? This has actually been one of the better performing retail stocks in the age of digital shopping. I've been waiting to get in on this stock for a long time, and now it might finally be at a somewhat attractive value. Now, the reason for them performing so well could be because people actually want to physically see and touch what they're going to be installing in their homes. Unlike other companies, Home Depot is actually not focused on expanding as much. Instead, it's been reinvesting those profits to focus on existing store improvement stores, as well as e-commerce, technology, and share repurchases. I'm sure that's everyone's favorite. Unfortunately, this can be a very cyclical industry as it focuses a lot on how the unpredictable housing market is doing. It's benefited greatly, just like its competitor Lowe's this past decade, as we've been recovering from the housing crisis. Home prices have actually went up 42% in the last 10 years, but there's been signs from the housing market that this may be slowing these past couple months, as the amount of Americans saying that they're looking for new homes has fell to just 12%. Now, this means that Home Depot probably won't be getting the same uptick in foot traffic as it's been getting these past 10 years. But it's still one of the industry leaders in home improvement and is a very profitable business model. It's also raised its dividend very aggressively in the past couple of years, meaning that the board of directors is very bullish on this company to return future value to its shareholders. But then again, I would hope that every board of directors is like that, right? The reason for this stock dropping recently is because they came in a little bit lower than what analysts expected for them in their Q3 earnings report, and they actually lowered their outlook for the remainder of their 2019 fiscal year. Management blamed this on Black Friday coming in earlier on the calendar in 2018 than in 2019, lumber prices being lower, and not rolling out on new operational development changes on time. But Home Depot did have higher than expected Q3 sales by 3.5%. Online sales were actually up 22%, as were sales in almost a dozen other departments. Home Depot is also investing $1.2 billion for its same-day or next-day delivery for its customers. This means that it's updating its aging computerized systems to support interconnected channels. So again, the stock fell because of a not-so-hot quarter and not-so-hot earnings report. This may lead into a great entry point, as Home Depot is now down from its 52-week high of $239 and slightly below its 200-day moving average. As with all of my videos, guys, this is not investing advice and is merely just me dropping educational content and probably just a summary of what I'm going to be doing in the markets. So again, I only own Starbucks, but let me know what you guys think of Public Storage, Home Depot, and Starbucks. And if you guys have any other video requests, please let me know, and I will try to get back to you in the comments.